All right, well, looks like we got the agenda on the screen. Welcome to the Moneymakers Club. Hopefully, there may be some other students joining us. We also have a couple of folks online joining us too. So the streaming audio seems to be working. But again, welcome. It's the first meeting of the year for the Moneymakers Club. So we are a investment club. Most of our members are beginners, although there are a couple of seasoned members. But it's all about education. Basically, the main purpose is to give you as much information, education, and tools to make sure that you build wealth on your own without relying on other people or paying other people to help build you wealth. And it's all about empowerment to build wealth. And so we always have topics every month. At both the Kent and the South campus, but it's 100% student driven. So if there are any topics that you already are curious about in any type of investment asset class or strategy or something you've heard of but you don't know anything about, I can always do the research since I'm the faculty sponsor, and we can always bring it up at a topic for the meeting. So for this first meeting, since it's the first meeting of the year, I decided to pick a couple of topics that are, one's pretty current and one is I brought back just because it can help anyone out there and it's all on dollar cost averaging. But now that you're on the mailing list, all the handouts are always emailed to all the members. So that way they can take a look at them later, use them for education resources. Also, once I put you on the email list, you'll also receive all the handouts and an educational package that we always give to all members of the club. It's totally free, of course, and it funds all. It's free. We don't have any fees. As a matter of fact, I'm actually going to be signing up this week to go down to the investment conference down in Orlando. There's a big annual investment conference called the Money Show in Orlando. So I'm actually need to get my registration soon for that. But it's great because it deals with all levels of investment experience, whether you are a beginner or a pro. They have all different types of workshops. It's Halloween week, so it's October the 29th through the 31st. It's a 3-day conference. The dates are odd because it is on a Sunday, Monday, Tuesday. So it's kind of weird that it's not on like a Thursday, Friday, Saturday. It's through the weekend, but they didn't used to do that. It used to always be on the weekend, like Thursday, Friday, Saturday, Sunday. But they kind of switched it a year ago after COVID. So they're on part of the regular work week type schedule, which is kind of weird. But yeah, it's down to Orlando. I usually drive. Last year I had a member of the club or a student come down and they would go to different workshops when I would go to different workshops and they would just talk about what we wanted. So it's a lot of fun. I always try to keep myself up to date in learning that. So just wanted to share with you that. That's upcoming. So if you have any interest in going to the big investment conference down in Orlando, you just go to the Money Show, which is the name of the website. It's really easy. It's pretty much the premier investment conference that they have in Florida, but it's nationwide. So they pick usually a lot of major cities to have events like Vegas or Chicago. In this case, Orlando is the closest one for this year. Next thing we always like to ask is that since we are a student-driven club, what are some investment topics that people want to learn, or maybe I would like to bring as a topic maybe for next month's meeting? Or anything you've always wondered about or not investing that maybe we can talk about?
One thing was, what do you buy split when you
stock splits? That's a good topic. I don't know if we've addressed stock splits at the club before. So what a stock split is when a company, if they are confident that their performance is going positively, and they think that the price of their shares are, if the board of directors think the price of shares may be a little expensive or out of reach some investors, then usually a board will declare a stock split to make the shares fall within a certain price range. Usually a price range for a stock to make it attractive, usually like between $30 and $70. That's attractive. But if you see stocks with prices of $400 a share, or like Alphabet and Amazon were 2 years ago, $3,000 a share, that's out of reach of affordability for many members. So stocks like Amazon, Alphabet, they went ahead and did stock splits, so they split their stock like 20 shares for one. Meaning that, for example, if I had a share of Microsoft that's $200 a share, and the board thinks that the share is too expensive, they say, well, why don't we split Microsoft's share 4-for-1? What they mean is, instead of owning one share of Microsoft at $200, I'm going to own 4 shares of Microsoft at $50 each. So in reality, you aren't any wealthier because that $200 is still worth $200. So instead of one share at 200, I got 4 shares at 50. Am I any wealthier? No. But psychologically, I feel wealthier because now I have 4 shares instead of 1. And now the shares are less expensive and more affordable, so that hopefully it'll attract more people to purchase the shares, invest in Microsoft, and make the stock more popular.
Who would get more benefit from the split in that rebate?
Generally, the people who buy the split right after or right before it splits,
Okay.
and the people that have already owned the shares benefit from the split. And that's probably one of the best things I liked about stocks I've continued to own for many years, is that they've split multiple times, and so it multiplies the number of shares that I have. So Microsoft's probably my best example, because when I was still a kid in school, I was working a part-time night job, and I used my part-time job money to buy 10 shares of Microsoft. Actually, I haven't sold them since. I still own those shares that I had since school, but because it splits, the 10 shares I bought, it's split 2-for-1, so that it was 20. A few years later, it's split 2-for-1 again. So those 20 shares doubled to 40. A few years later, it's split 2-for-1, then 80, then it doubled to 160. Hey, come on in. There's a sign-in sheet. We got handouts too. We're just discussing one of the topics about what we like to learn about for future meetings. So yeah, stock splits is probably something that we can talk about for next meeting. I probably don't think about for that. That's a good one.
Cause next door with the guy at America Online.
Oh,
Then,
wow,
Yeah.
I remember America.
yeah, he was a manager and he bought the stock from the day one and
Yeah.
split twice, 3 times, and he said he was telling me that he was going to retire.
Yeah, I would have loved to sell it when it was split at that time, before this stock tanked.
Yeah, that's what he did.
Yeah. If I'd gotten that before America Online fell out of popularity, then yeah, I would have been very retired like that. But hindsight's 2020. Yeah, stock splits, it's a good one. As a matter of fact, I'm gonna make a note of that as one of the topics for a future meeting. Could do that before I forget. Let's see something. Any other topics that you think would be good to talk about for next month?
I'm gonna get it.
I mean, I think I discussed it recently when I did this meeting. My situation that was, I have the.
Oh, yeah,
money
the
goes
funds
Right, and,
and how they're managed and,
right,
yeah.
versus being in credit union or bank versus being in, like, a bank or having to do with some
yeah, so like bank IRAs versus fund IRAs. Good one, that's something we haven't really discussed. So we have, oh yeah, go ahead.
One of my favorite youngest son is Marcus. So what is the insider trading?
Oh, but insider trading. We actually talked about, we talked about that in chapter 2 of the thing. Basically, what insider trading is you buy or sell a stock based on information that you have that no one else. And so, because of efficient market theory, basically, and in fairness, why we have regulatory agencies, market situation is supposed to be where everyone has equal access to information. And then the stock price is reflective of all known information. Someone has something at that advantage. The reason why it's illegal is because they can profit or take advantage of profits that adversely affect everybody else who don't have that opportunity. So that's insider trading. Yeah,
Okay.
yeah. So if like, even as something as simple as the guy mopping the floors late at night
Okay.
overhears something that a company officer is doing in the next room while he's cleaning, and then we trade on it. That's nice. So let's introduce ourselves as folks sitting in. Of course, we got a couple of folks streaming online, but we'll do our introductions for the folks here in person. So I'm Professor Alaska. I'm the faculty sponsor for Moneymakers Club. So totally happy to have you here for the first meeting of the school year. Hopefully we'll continue it once a month, but I'll let my students.
Victoria Anderson, I think we're financial management on FSCJ.
That's your vote. I'm in previous segregated management. Region as well.
Not to community. It's, I don't know, something in this world with like development.
That's the wonderful thing about taking college classes is that it exposes you to all sorts of pathways that you may not have considered as you kind of decide on major. When I did my undergrad, I had 3 different majors before I figured out which one I wanted, because the more class I took, it sounds kind of interesting. So yeah, it's wonderful. And I remember we met at South during the recruitment fair. That's awesome. Okay, well, let's see. Members, story topics. Next thing we usually like to spend 5 minutes on is what I always like to call market awareness. I always look at the news a little differently because it allows me to focus on news items that if it warrants my attention, it must give me an idea of a way to make money. If it's just fluff or politics or stuff that, if it doesn't give me an idea to make money, then I don't know. Let me worry about it. But what the market's been doing lately, looking from an economic sense, I think we know that interest rates been going up for the past year and a half. And today is what finance guys would call a binary event, meaning that the Federal Reserve, which basically makes decisions on interest rates, in the next hour and 15 minutes is going to come out to decide whether or not they're going to raise interest rates. There's probably a 99% chance that they will not raise interest rates today because inflation, even though it went up slightly a couple of weeks ago, it still looks like it's still lower. The trend is still lower time. The big question now is, based on the language of what the Federal Reserve talked about this afternoon, which definitely moves markets. Markets hang on the edge of every word that the chairman of the Federal Reserve talked about when he speaks. So our 15 minutes, markets will go up and down based on every single word that he says today. There's a prevailing opinion that even though interest rates won't go up today, that interest rates might go up the next time the Federal Reserve makes an announcement. And so the fact that interest rates go up is usually not a happy kind of thing. The reason why is theoretically, if interest rates go up and businesses have to pay more interest, borrowing money to spend on things like hiring people, buying companies, then higher interest costs, increasing profits. Decreased profits, lower the stock price. And so when analysts or buyers and sellers of stocks project that prices may be, or profits may be trending downward because of higher costs to the business, like interest costs, then generally will bid the stock price down. And that's not necessarily great. So markets don't like it when interest rates go up. In a normal market, over time, interest rates go up over the long term. But right now, it's called the yield curve, means interest rates in today's environment are expected to drop in the future, like a negative yield curve. So usually when you see an environment where interest rates are projected to be lower in the future rather than higher in the future. So we're kind of in a catch-22. We're in a recession, but we also have high inflation. And usually, if we have one but not the other, the Federal Reserve can fix it. If we have high inflation and the economy is doing bad, or if we have high inflation, then Federal Reserve raises interest rates to get inflation down, which is why last year inflation was 9%. This year it's close to 4%. So it's about half, but it's still high. The target is 2%. Spoiled with low inflation for over a dozen years, from 08 till the pandemic. So for a lot of people, this is the first time people were experiencing really, really meaningful inflation where everything is expensive right now. The problem with raising interest rates is when the Fed raises interest rates, economies don't like that either, and sometimes that could plummet into a recession, which is also coming. And in order to prevent a recession from being as painful, generally, the Federal Reserve likes to lower interest rates to encourage people to spend more money and get the economy jump-starting again. Problem is, we are in both a recession and inflation. So if the Fed lowers rates, that increases inflation, which is bad. But then if the Fed increases rates, that exacerbates the recession, which is also bad. So I don't envy the job of the Federal Reserve to try to have to balance that. I think the decision is basically the Fed has to stick to their guns to keep raising interest rates to get inflation down. And they are just accepting the fact that it's going to drive us into a recession no matter what. As the cost of making inflation at least come close to 2%. If they can get it between 2 and 3%, I think that'd be fine. It's a tough economic environment right now. And so the market's been kind of in a range and actually going lower just because they're waiting on pin and needle to see what it's going to do. Reality also has the same thing to do with the markets right now. Traditionally, historically, and this is going back for decades of data, the weakest months of the year for the stock market are usually the last two. The biggest market crash in history happened to occur in October, which is next month. So these are traditionally the weakest months of the market. The markets usually go down, and markets usually go back up in November, December, and usually call it Christmas rally. Although that doesn't always happen. The highest average market returns per month are usually like November, the range between November. And then they have this phenomenon called selling May and go away, because then a lot of traders go off for the summer and the market do off for that time. So we're kind of like in the low months of the market. And it doesn't help that the Fed's been raising interest rates on top of that. So that's kind of like the environment we're in when it comes to the market. So the first handout, which I'll stick on the screen, but we also have the paper handouts as well. And those of you that are on the email list, I'll make sure to email you after the meeting all the handouts that we got. And here it is on the screen. It's up a little bit. There we go. So dollar cost averaging is a really cool trade. Anybody ever hear of dollar cost averaging? So dollar cost averaging is a tried and true way to take luck and timing out of buying stocks. You don't have to try to time when's the best time to buy a stock, or am I getting at a good price or not? You don't have to worry about it. The key is and this is only after you picked a company where fundamentally you know it's the right company to buy. As long as nothing has fundamentally changed why you wanted to buy this stock in the first place, whether it's a great product line, or great revenue, or great sales, or a product that its competitors have a hard time copying, whatever. Dollar cost averaging is a way to invest in the stock without having to worry about price. As long as nothing has changed in why you bought in the first place, It's a great strategy. And what it does is, the aim of dollar cost averaging of the strategy is that whenever the stock drops in price, as long, even if you still, as long as you still like buying the stock, that means dollar cost averaging lets you buy more shares when you're cheaper. And if the stock eventually goes back up in price, dollar cost averaging prevents you from buying too many shares when they're more expensive. Over time, the average price you pay for the stock will be lower as the stock slowly, as long as, you know, it's a good one.
I have a question about the changes in it. So if a company sold potential or potential insurance sold to Aetna, they gave employees. And so that company, it sold to Aetna, and then Aetna now has sold over. Happened to that original stock?
Well, usually there's going to be a handout given to the owners of the stock explaining what the stock converts to. So if, when Prudential got acquired by Aetna, usually there's a handout given to all the shareholders that say, all right, now your conversion of Prudential stock is going to equal maybe a 1-for-1 share of Aetna, or maybe if your 1 Prudential equal 2 share of Aetna, or whatever ratio they decide. So that there's always notification of all the shareholders about what the conversion is. I've had that happen to me several times when I own stock or companies that turn into, they always inform the shareholders. So, okay, dollar cost averaging. So again, it's a great way to average in, which is why it's called that, over time, where you buy more shares when they're cheap, less shares when they're expensive. Over time, as long as you still like the company fundamentally, the price you pay is always going to be lower than the stock price. And the mechanics of dollar cost averaging is this: as long as you put in the same amount of money into the stock around the same time each month, then you'll take advantage of this strategy of dollar cost averaging. I do it myself every month. For example, every paycheck at the beginning of the month, what I'll do is I'll allocate $100 into buying a share or a piece of Amazon stock, and then a piece of Alphabet stock. And then I'll also have money going into some high yield ETFs, which is actually very popular. So last year, when Amazon stock and Alphabet stock was below $100 a share, when the market had a bear market in 2022, that same $100 was buying me more than 1 share of Amazon every month. So I was buying more pieces of shares when they were cheap. Now that Amazon stock and Alphabet stock is about $130, $140 a share, every paycheck I'm buying Amazon and Alphabet, which is Google, I'm buying a fraction of a share. So I'm buying less pieces when they're more expensive, but that's okay. Because when they were cheap last year, I bought more pieces when they were cheap. So my overall average price of my Amazon and my Alphabet shares is still cheaper than what the price is there. So I'm averaging in at lower using this strategy. I've been doing it for years. I did it with Pepsi, I did it with Microsoft, I did it with Exxon. So I've been dollar cost averaging with a lot of different companies where my average cost is lower, and then as long as nothing's changed or why I still like the stock, then I'll always have an average cost cheaper than what the real price is currently. And the bonus is, if the stock pays a dividend, then I take those dividends and I reinvest in shares also. Like my Microsoft stock just paid a dividend last week, a quarterly dividend last week. I'm reinvesting all that money into buying new stuff instead of keeping the cash. So I put a great chart here that shows a mathematical example of how it works, which is a pretty nice example. So let's say we get paid $1,000 every 2 weeks, and we decide to put 10% of that. So we say 10% of our paycheck every pay period, which is $100. We decide to put half of it $50 into an S&P 500 index fund, which is a great starter investment. If you don't want to do the homework on individual stocks, buying an S&P 500 mutual fund or index is just same thing as just buying the 500 biggest things. So pretty easy. S&P 500 and then the other half, $50 into another stock. So if we put $50 in for our first pay period, we're going to buy 5 shares at $10 each. So now we own 5 shares and we have a total value of invested at $50. The next pay period, the shares are now worth $10.50 each. I'm going to put the same $50 in that pay period. We buy less shares now that they're more expensive. We only buy 4.76 shares. Now we own 9.76 shares. And now the value of our investments are $102.50. The price of the shares go up to $10.75. Now we buy less shares at $4.65. Let's jump down to pay period number 6. All right, market's down that particular month. So each share is only worth $9.95. I'm still putting the same $50 every pay period in, but now instead of buying 5 shares, I could buy 5.03 shares. So now we own 23 shares, almost 24 shares with a total value of $244.32. So we do this month to month to month. So by the 10th pay period, the shares are worth $11.25 each, but since I've been using the dollar cost average technique, each share only cost me $10.48. And so the value of my shares is $536. So which means that I've put in $500 out of my pocket, but the value of my investments in total is $536. And dollar cost averaging is a really great technique. As long as the stock you are using this technique, it's a good one. Yeah. Yeah, you're evening out the ups and downs of the market over time by keeping your payments constant. So it's a technique that's worked for me, and now if anything fundamentally changes about why you're buying that stock and you don't think it's a good stock anymore, yeah, then definitely divest yourself out of it and pick another one. But the technique works very well. Like my Amazon and Alphabet, and I used to do it with Netflix. Acquired a lot of shares that way. All right. Before I go to the next topic, just a plug. All of my officers graduated this past fall. So I did have one email saying she may want to be my new secretary, but all the officers' positions are open pretty much. So we got president, vice president, and treasurer. So I might have a secretary who just applied today. But also want to welcome Tim, Navia, thanks Alicia, and of course Michael, our manager here at the Fintech Center, is online as well. Let's go into our last topic, which I find pretty interesting. This is a brand new thing this year, or actually just within the past few months. If I can move this up a little bit. There we go. All right, yield max ETFs. These are pretty cool. I just started investing in these months. So first of all, what is an ETF? So are we familiar with what ETFs are? Yeah, we made it. Basically, it's like investing in a mutual fund, but you can buy and sell shares just like shares of stock. And each ETF represents a particular objective, whether it's a sector of the economy or maybe just the S&P 500 or the NASDAQ or any of the types of areas in the market. But what a yield max ETF is, which is kind of a new invention, is that instead of an ETF focusing on a particular industry, sector, or area of the economy, ETF or yield max ETFs are focused very narrowly on just one company. So the whole ETF is just one company. So the strategy is, to attract investors, is what they do is they pay dividends every month instead of every quarter, like most stocks do. What is unique about the yield max ETFs are, well, basically two things. One, the rate of dividends is pretty high, but two is how they earn income for the ETF is also very unique. What they do is they sell call options to generate income, usually out of the money or above the current stock price of that particular stock. And the income that they generate, which is called a premium, like selling insurance, is then distributed to the shareholders. So the expense ratio for the fund is kind of on the high side, 0.99%. So it's almost a 1% expense ratio. And I usually am not as keen on paying expense ratio, but the reason why that hasn't deterred me from buying shares in some of the yield max ETFs is that the returns, at least so far, they've had a good track record of high dividends. And I'm going to show you the examples of what they're paying on the screen here. So let me switch from monitor to monitor. An example. Yeah.
Options, you're basically saying you want to offer a short sale of ETF.
Well, they're not short selling it. What they're doing is they are, and I put this in the handout to try to make it as simple a concept as possible. What they're doing is they're synthetically owning 100 shares of stock. So the strategy is what's called a covered call strategy, which I use myself. Basically, what they're doing is they're the premise is you own 100 shares of stock, and you sell a call option, meaning that you're giving someone the right to buy your shares from you at a certain price. So let's say Microsoft is selling for $140, and to generate a little extra income, I sell a call option to someone, giving them the right to buy my 100 shares from me for $160. So Microsoft's at 140, and my call option is at 160. Then as long as the stock doesn't reach $160, then their right to buy my shares won't execute, or they won't have any incentive to do that, to buy the share. Because why would they want to buy my shares at 160 when they could just go ahead and on the open market and buy them for 140? The reason why people would be wanting to buy that option is if they think Microsoft shares will someday be above 160. Because if Microsoft ends up being $200 in the future, and they have that right to buy them at 160 from me, they'll exercise that right, buy them at 160, and then now they have stock at 1,400, which they only bought. The thing is, in order for me to sell that option, I charge for it. So I would charge a premium, that's what it's called, and that's income to me for the right to buy my shares at 160. So as long as the stock stays at 140, goes even better, goes below 140, or even worse, but still okay, goes up to $159.99, but then the option expires, because options have a limited life and expiration date. As long as it expires and that option gets exercised, whatever I collected in cash to sell that option, I get to keep it all. So what YieldMax does is they will sell options on the stock that they own and collect a premium, but then they set the strike price, usually about 5 to 15% higher than what the current stock price is. So what they'll do is, if the stock never goes up to that price, then they keep the premium and they share the premium with the shareholders. What if the stock goes up to that price? Well, that's okay, because then they sold the stock or a small profit, 5 to 15% profit. To protect themselves, they ought to, in case the stock price drops in value, they also buy a call option and they sell a put option to pay for the stock, or to not have to buy the actual 100 shares. So they'll also use options to artificially own the 100 shares of stock as well. So a strategy to also protect themselves is that they're only using about 25% of their assets to do the strategy. About 75% of it is in treasury bonds, so it's mostly in cash to cover themselves. So the hedge is large, which is also nice. But what I want to show you on the screen, which I have it up right now, is why these have been attractive lately. This is the yield max, and each ETF is based on just one stock. The first four that came out, this one's ARK Invest, which is a known tech stock fund investor. They made an ETF of that. I think you could probably guess what this ETF is for. Represents Tesla. This one is Apple, and this one's NVIDIA. Some of the biggest names in the business. But what draws most people's attention is the distribution rate. So think of how much interest that you're getting in your savings account. 1%, 2%. Although even though interest rates are over 7% right now, the bank's still going to give you a little bit. If you apply for a loan, yeah, they're going to charge you a lot of interest rates, what the market rate is. But compare that, or compare like what you're earning on a mutual fund, 8-10%. And those are great rates. 8-10% is standard for most. But these particular funds are generating cash income dividend payments 31%, 48%. Apple is a little more conservative, 13%, which is still higher. And then NVIDIA, 51%. I just got paid my dividends from all four of those just a couple days ago. And since I split up my cost or my money and try to make it kind of equal between four of these, I think overall, if I averaged out the cash that I spent versus the return, I think I got about 40% dividend rate, which is still really attractive. Now, since these funds have gotten a lot of investments, they started creating more. So a couple of months ago, they added these. You probably guessed Amazon. BB is Facebook, or a company called Meta. GUI is, and Netflix is Netflix. So I bought just a couple shares of each of these. I believe these four paid their very first dividend last week. So these are really brand new. And then just last month, they created four more. And I think they're going to keep on creating them because there are a lot of well-known stocks they can make these funds for. So this is Coinbase, and if you like crypto, since Microsoft, Disney, ExxonMobil. They haven't paid any dividends yet, just because they're new, but I suspect they'll probably pay their first dividend probably in a couple of months, probably in November. And then literally yesterday, these two just came out yesterday. Well, AMD, which is AMD, like they make chips. This one came out yesterday. I think this one came out maybe a week ago. This one's JP Morgan. So it's not just limited to tech. We got banks. We got one of the biggest oil companies right here, ExxonMobil. So fascinating yield max strategy to generate high dividends. So what does that look like in terms of dollars? Well, if I'll put a calculator up here, way we can actually see. So, for example, if you invested $10,000 and you earned a, let's say conservative, let's say 30%. 30% annual return, that's $3,000. So you can, theoretically, if you have $10,000 invested across the funds, and on average, because they all go up and down, gave you 30% annual return, that's $3,000 in income. But as you probably noticed, like especially with the Tesla and the NVIDIA, which are really hard to fathom, but at a 50% clip, we got 10,000.
Reason to have 75% in cash, just to back that up. Or?
Yeah, that's to back it up. Yeah. So if they had to buy the 100 shares, then they have cash to pay for. So at the 50% clip, like the NVIDIA and the Tesla, it's even more mind blowing to me. $10,000 investment, you get 5,000 back, a year. So very impressive rates. Of course, the jury's still out. Can they sustain it?
Yeah.
I'm investing in them, but again, it's not like the bulk of my investments. But the fact that the dividends they've been able to afford to pay the dividends fairly consistently, and the fact that I can spread out and diversify under different funds. So I don't have to put all my money in one basket into like 4. As they start developing more, I'm adding to them. So I've got the Amazon, I've got maybe share the Facebook. I think about that yesterday. A couple of the Googles, a couple of Netflixes, a couple of the Microsofts. I'm not doing the Disney one. The ExxonMobil, I'm not sure about. But I do have most of them in the OR, Tesla, Apple, and NVIDIA. So for now,
the option
yeah. As a matter of fact, I've bought them across 3 different platforms. I bought them in my Tasty trade account. I bought them in my Robinhood account, and I bought them in my Eagle account. And all 3 of the accounts paid me my dividends just this week. So see if, but yeah, it's a fascinating setup. And if they can consistently, even if they aren't, depending on the market, able to sustain a 40% return, even if it gives me 20-30% return, 20% return, that's still a lot more than I can get in most places. And the nice part is you can buy them, sell them just like shares. You can get them commission free on those platforms. Now my Tasty trade for some reason doesn't have the AMSI, DB, GUI, and some of the other ones, but it has the first 4 in my Tasty trade account. But I'm assuming at one point they will.
All the 3 platforms you just mentioned, which one do you like the best?
Well, in terms of speed and customer service, right, especially since we're all Tasty trade by far, or Tasty works by far. And that's just because I've had amazing customer service with them. Not only can I get a response in email within a matter of minutes to an hour, but the way that the company philosophy is everyone works and is treated equally. So you can, they have their regular TV show on as well, but when you get an email response back, you may get a response back from one of the TV personalities. Doing customer service just as the CEO himself will answer an email first. I've done it a couple times. By the most laid back average billionaire. I don't know. But yeah, it's just philosophy of the company. The Tasty works. I don't know if you've heard of the company TV Ameritrade. You've seen some of the commercials. But Tom Sosnoff, who was the founder of Tasty, he and his engineers, because he used to be a trader at the Chicago Board of Exchange for 20 years. They came up with software that eventually became TD Ameritrade. They had a swim platform. They sold it to TD Ameritrade for about $700 million. That would he took the $700 million and decided, well, let me make a better, we're going to create a better platform. Took the software engineers with him and started his own company, TastyWorks, and then started his own little TV channel, and TastyWorks is broadcast every day. And I like to watch all the videos from there. They have like the really fast auction platform, very, very low commissions for the stock. It means no commissions. I think their execution is about 200 milliseconds. They keep it fast. But what I like about versus Webull and Robinhood, and I like those, is that the prices I usually get or the trades are usually more favorable. I'll put a trade for a price at a certain dollar amount, and when TastyWorks executes it, sometimes it'll give me a better price than what I have, which is really superior. So I really like that. And no, I'm not paid by them, but I've been using them since 2017 when they were a newer platform.
So this is not a sponsor, yeah?
No. I would love to have them sponsor me because then I could sure use the side income, but no, they're just a wonderful platform, really responsive on customer service, and all their educational resources are spot on and free. So you can look for a lot of them on YouTube. They've got a huge library of educational resources, which I believe I included in the educational resources handout that I give to all the members. So when I email out the handouts for today's meeting, it'll be in the Moneymakers Club educational resources handout. So the links to TastyWorks and all that will be in there too. So I think.
This that you met,
Mhm.
this is from the underlying stock.
The risk is, from the underlying stock not doing well, which is why the fact that they're starting to grow the diversity of choices means you don't have to put as much spread out the risk. But I like the fact that when they started picking the one stock to create an ETF, they picked probably some of the more for lack of a better word, stable names, because nothing's totally stable, that are probably not going to go out of business anytime soon. So your Apple, NVIDIA, Microsoft, Amazon, I mean, they're definitely not going out of business anytime soon. So the risk of those stocks tanking in value is probably not as high. So the reason why they're able to generate such high returns is what's called volatility. So when volatility is high, even with tech stocks, that's good if you're an option seller, because the more volatile a market is, the more you can sell those premiums, the insurance premiums. When you sell an option at a strike which is higher than the stock price, and you try to sell it for as much premium as possible. I'm an option seller, so I always try to sell it for as much premium as possible. So when there is higher volatility in the market, especially when the market is down, you can sell those premiums for more money. When you sell them for more money, then that's how they can afford to pay out your returns on the shareholders. So if volatility is high and they can generate those premiums, they can sustain. Now, what if volatility is lower or stock price is stable? Well, they may not be able to pay as high a premium, but they can still capitalize on the strategy by selling premiums out of the money. Because if volatility is low and the stock pretty much stays where it is, those options contracts are just going to expire worthless, and they'll just keep on wash, rinse, repeat. Just keep on selling those option contracts at a price 10 to 15% higher than the stock may ever reach. So it's a strategy that works in options trading, and that's pretty much how I do my option trading. I always am a seller, not buyer. And they've been able to actually apply the strategy to an ETF for the first time, which is fine. I wanted to share this with you guys because it's fascinating. But again, like I always say, everybody has their own risk tolerance, so look at your own risk tolerance. And don't put all your eggs in one basket, so diversify. So have the risk that you're able to tolerate to earn a reward. But you always want to try to beat inflation. That's definitely what we're doing. But that is what I got for the agenda today. Thanks for coming out, but before we go, yeah, comments, questions. Yeah.
But I mean, is there any way you could go and find out like a black market for W would mean? This is how you should.
Yeah.
But you should.
Yeah, when I email the educational resources, I actually have websites, books, video links where you can definitely get started.
Oh.
For beginners
Go
and,
bigger,
yeah, for sure. I've links to both stocks and options trading capabilities too. So, yeah, it's in there. It'll be in the email. As long as I can read your email and sign it sheet, then I will make sure to attach the education resources. For sure. All right, thanks, everybody.
Appreciate that. Thank you.
All right,
Appreciate it.
see you in class.
An email.
Well, I could probably put a link to the video. I just got to post the video. Yeah.
And the schedule, when the meetings are.
Oh, yes.